Hi everyone, and welcome to the channel once more. Today we're diving deep into one of the most potent yet most misunderstood aspects of building wealth, the tax advantages of real estate investing. This has nothing to do with loopholes. This has to do with understanding the lawful and strategic instruments the tax code makes available to you in order to keep more of your money. We're going to break down how you can use such items as immediate deductions, depreciation, and tax deferral strategies to double and even triple your cash flow and profits, from the moment you buy a property, right through until you sell it. Pay attention, because this is the type of content that can completely shift your financial situation. All right, let's get started with the fundamentals. Before you pick up any of the smart strategies, the secret to smart real estate tax planning is getting your arms around your immediate operating expenses. This is your line of defense against the taxman. These are the everyday expenses that immediately reduce your rental income dollar for dollar, keeping money in your pocket today. So what counts? Well, the big three are property taxes, your insurance premiums, and this is a huge one, your mortgage interest. If you're using leverage to buy a property, that mortgage interest is often your single largest tax deduction in the early years. But it goes beyond that. If you're running your rentals as a real business, you can even write off the expense of your advertising, your home office or a separate office space, business equipment like your computer, legal and accounting fees, and even travel expenses to handle your properties. The key is diligent documentation. You record all of this on a part of your tax return entitled Schedule E, and if you have more than 3 properties, you just attach further schedules. It's all about building that rock-solid operating shield. And a few words about the undisputed star of real estate tax deductions, depreciation. I call this one a phantom deduction. It is a non-cash deduction in the sense that you don't actually write a check for it, but you are permitted to claim it by the IRS as a way of reducing your taxable income. Here's the overall idea. The building itself loses value over time, right? So the tax code lets you recover that cost. You can't depreciate the land, but you can depreciate the building. The IRS set up standard periods for this through something called the Modified Accelerated Cost Recovery System, or MACRA. For residential rental property, you depreciate the building over 27.5 years. For commercial property, you depreciate it over 39 years. Let's do it. When you buy an investment residential property and the building itself costs $300,000, you can depreciate some $10,909 every year for 27.5 years. That is over $10,000 subtracted from your income without laying out 1 penny extra. It's a weapon with great power in creating what's called a paper loss, which can obscure your actual cash flow from tax. 27.5 or 39 years. That's great. But if you'd rather have deductions in your hand now, that's when smart investors use a method called a cost segregation study. Essentially, it's turbocharging your depreciation. A cost segregation study is an engineering study that breaks your property down into its individual components. It identifies all the items that possess a finite useful life less than the building shell. After those are established, you can take them out of that long 27.5 or 39-year window and depreciate them a whole lot faster. For example, carpeting, specialty lighting, and cabinetry would be 5-year property. Office furniture might be 7-year property. And land improvements like landscaping, fences, parking lots, and sidewalks can be 15-year property. And by breaking these costs out, you will have the ability to claim giant deductions in the initial years that you own the property, instead of waiting decades. And on top of cost segregation, we also have bonus depreciation. This provision allows you to take a full frontal, upfront write-off of much of that accelerated property we talked about earlier. But, and this is a whopper of a but, this window of opportunity is rapidly closing. The bonus depreciation rate is presently in the phase down. It was 100%, but that has run its course. In 2023, it was 80%. Now, in 2024, it's 60%. In 2025, next year, it drops to 40%, and by 2026, it will be only 20%. This creates an enormous sense of urgency. If you have a major acquisition in mind or own property that you have not completed a cost segregation study on to date, doing it now to lock in that 60% bonus rate is an imperative move. The earlier you procrastinate, the lower the short-term tax savings will be. So if you can visualize this, think of your property like this chart. You have your main building depreciating over a long life of 27.5 or 39 years. But then you assign all these 5, 7, and 15-year assets through cost segregation, and you receive bonus depreciation on them. When you combine cost segregation with bonus depreciation, what we're trying to do is engineer a ginormous paper loss in year one. What that generally will be is much more than any cash flow the property really is going to produce. Now, constructing this massive loss is a brilliant plan, but it puts us squarely into the next big challenge we have to navigate: the passive activity loss rules. Next, let's switch gears and talk about a very mundane source of confusion and audit risk: being able to tell the difference between a repair and a capital improvement. It matters to your cash flow. A repair is that which keeps your property in functional shape. You're just restoring it to the shape it was in. You're not improving it. Think about fixing a roof leak, fixing a broken toilet, or replacing a small plumbing device. The best part about repairs is that they are deductible in the year in which you pay for them. A capital improvement, on the other hand, is something that enhances value, alters the property to another use, or increases its useful life considerably. This could be installing a completely new HVAC system, replacing an entire roof, or installing an additional room. These costs must be capitalized, meaning you add them to your property's tax basis and depreciate them over the 27.5 or 39-year period. One large trap here is the plan of betterment. If you're doing a lot of little repairs at the same time as a large fix-up, the IRS can say that it's one huge improvement project and force you to capitalize the whole thing. So protect yourself. Get detailed separate invoices from your contractors that break down what was a repair and what was an improvement. To help us with all of that, the IRS actually provides us with some safe harbors, ways to make things easy and expense more of your costs immediately without fear of an audit. First is the de minimis safe harbor. This lets you deduct items under a threshold amount all at once. If you do have formal accounting records, the limit is $5,000 per invoice or item. For the rest of us who lack such statements, it's $2,500. You just need to elect this on your tax return annually. Below is the routine maintenance safe harbor. It encompasses items which you reasonably anticipate to have done more than once during the life of the property, like annual maintenance of the heating and air conditioning or repainting between tenants. You can immediately deduct these costs. Finally, for small landlords, there's the small business safe harbor. If your average annual gross receipts are $10 million or lower, and the basis of your building is lower than $1 million, you can deduct the lesser of $10,000 or 2% of the property's value for improvements, repairs, and maintenance annually. These safe harbors are sledgehammers, so large that you'll want to make sure you're applying them. Okay, so let's revisit that huge paper loss we created with accelerated depreciation. Catch this. By default, the IRS treats rental real estate as a passive activity. And the passive activity loss, or PAL, rules dictate that passive losses can normally only offset passive income. They cannot be used to offset your active income, like your W-2 salary from employment, or your portfolio income, like dividend income from stocks. So if you have a $50,000 paper loss from depreciation and no passive income, that loss is suspended. It's not lost, it's rolled forward indefinitely until either you have passive income to use it against or you sell the property. There is a single exception for smaller investors. It's the special allowance. If you actively participate in your rental, i.e., you're a part of big decisions like approving tenants and setting rent, you can deduct up to $25,000 of passive losses against your regular income. But there's one giant loophole. This savings phases out when your income rises. For every dollar that your modified adjusted gross income, or MAGI, is over $100,000, you lose 50 cents of that $25,000 break, When your Maggie is $150,000, the entire break is lost. This leaves us with a traditional trap. The taxpayers who benefit most from large depreciation losses, high-income professionals, are the same ones phased out of this special allowance. So if your income is over $150,000, this $25,000 rule is basically worthless to you. You need an alternative. Here's a handy chart to illustrate those phase-out rules. For married filing joint or single filers marrieds, the phase-out is between $100,000 and $150,000 of MAGI. For married filing separate, more stringent, and if you were married last year, you don't get to use the allowance. Therefore, for individuals who earn high incomes, the key to claiming those deferred losses is obtaining something known as real estate professional status, or REPS. That is the holy grail. If you can obtain it, your rental activities are no longer passive. They're active, and you can deduct those real estate losses against every last dollar of your ordinary income, including your wages. But the IRS isn't that kind. You have to pass 2 stringent tests every year. First, the more than 50% test. You have to perform more than half of all of your personal services for any real estate business. And second, the 750-hour test. You have to work at least 750 hours during the year in those real estate businesses. This isn't a joke. The IRS is watching this closely. You'll need to keep contemporaneous, detailed records of your time, such as a diary of what you're doing, showing what you did, how long you did it, and where you did it. If you can't document those hours, you'll be disqualified, and all those losses will instantly go back to being suspended. And it doesn't stop there. Once you are a qualified real estate business person, though, you also need to show you materially participate in every rental activity. The IRS has 7 of them, but the main ones are pretty simple. Did you spend more than 500 hours in the activity this year? Or did you spend more than 100 hours, and was your part more than any other person? There's also a test if you have several pieces of property and your total real estate activity is over 500 hours. The concept is you must be really actively carrying on your real estate business. All right, now on to the granddaddy of them all, the 1031 like-kind exchange. This is how you sell a property, generally for a gigantic profit, and legally put off paying any capital gains or depreciation recapture tax permanently. The law is simple. You sell one investment property, the so-called relinquished property, and you take the proceeds and buy another like-kind investment property. The phrase like-kind is miraculously generous for real estate. You can exchange raw land for an apartment complex or a strip retail mall for a warehouse. The most important rule is that you can never actually touch the proceeds of the sale money. You must have someone else, a third party, called a qualified intermediary, or QI, hold the cash and assist you in purchasing the replacement property. If you actually receive the cash, even temporarily, the whole deal is no good, and you pay all the taxes. The 1031 exchange is governed by 2 of the most severe, most heartless deadlines in the entire tax code. They start on the day you close on the sale of your old property. First, you've got 45 calendar days to formally identify in writing the potential replacement properties you might buy. Second, you've got 180 total calendar days to actually close on the purchase of one of the identified properties. There are no extensions. If you're late with either of these deadlines, your exchange fails and you owe all the taxes immediately. And if your 180-day period runs into the next calendar year, you need to file an extension on your return because you can't file your return until the exchange is complete. The biggest risk in a 1031 exchange besides timing is receiving something called boot. Boot is anything you get in the exchange that is not like-kind property, and it is taxed outright. There are 3 common forms. First, cash boot. This is any sale proceeds you don't reinvest, or cash from the exchange spent to purchase an item such as repairs or loan expenses on the new property. Second, and this is a sneaky one, mortgage boot. If the mortgage on your new home is smaller than the one you just paid off on the old home, that debt relief is taxable boot. You've got to keep or continue your leverage. Third, personal property boot. If you get any non-real estate property like furniture or equipment along with the bargain, That's taxable boot too. So when you finally sell a property and don't trade it via a 1031 exchange, you get to greet the tax man. Your gain is split into two for tax reasons. If you've held the property for a year or less, it's a short-term gain and taxed at your higher regular income tax rates. And if you waited more than 1 year, it is a long-term gain, and that entitles you to 0%, 15%, or 20% preferential rates. But wait, there's more. Remember all that depreciation you happily wrote off year by year? The IRS would like to get some of that back. This is depreciation recapture, or technically unrecaptured Section 1250 gain. The entire amount of straight-line depreciation you've deducted is taxed at a maximum rate of 25%, separate from your income. This is actually the secret genius of the whole system. You charge depreciation against your ordinary income, which could have been taxed at 37%, and now you are only paying a 25% rate to pay it back. That's incredible swap. Let us take a simple example and make it real. You bought a property for $390,000, and your adjusted basis is $290,000. You sell it for $500,000. Your total gain is $210,000. Assume during the years you took a total of $110,000 in depreciation deductions. That $110,000 is your unrecaptured Section 1250 gain, and it is taxed at that special 25% rate. If there was a small deviation from some accelerated depreciation, that small segment might be taxable at your normal rate. The remaining $95,000 of pure appreciation is your long-term capital gain, taxed at those lower 0%, 15%, or 20% rates. You have to prorate the gain like this on your tax return. Another ultimate plan most individuals ask is if you are able to convert a rental property into your primary home. You are then able to use the Section 121 exclusion, which permits you to exclude gain up to $250,000 if single, or $500,000 if married, upon sale of your main home. To qualify, you will have to own and use the dwelling as your main residence for a minimum of 2 of the 5 years prior to its sale. But that is the critical catch. You can't exclude the gain on depreciation. Any depreciation that you took, or even were allowed to take, after May of 1997, you are still fully taxable at that 25% recapture rate. You might be able to exclude the appreciation, but you'll always have to pay the taxman for depreciation gains that you've already experienced. So let's get it all done. Real estate tax savings are a godsend, but they require some planning and initiative. First, act on bonus depreciation. That window is coming down fast, so if you're buying or doing a cost segregation study, now is the time. Second, if you're using a 1031 exchange, understand the compliance. Those 45 and 180-day deadlines are no joke, and Boot can initiate a nasty tax bill. Third, for those of you with high incomes, seriously, consider applying for real estate professional status. It's the sole answer to deducting large paper losses against your income, but be prepared to document it all. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.